Welcome to The Explainer. So today we're digging into a real head-scratcher from Wall Street, AeroVironment. They just posted absolutely record-breaking sales. But get this, instead of popping champagne, investors basically ran for the hills. We're going to find out exactly why. Okay, let's just dive right in, shall we? The market's reaction here, it tells a story that the big, flashy headline numbers just don't capture. How on earth does a company announce its best sales ever and then watch its stock just crater? That's the big puzzle we're here to solve today. And what's just so fascinating when you look at this is that sheer disconnect. The stocks didn't just kind of dip. No, it dropped right after the company was shouting from the rooftops about record sales and this massive new contract. So right away, this wasn't a revenue problem. The real issue, that was buried way deeper in the numbers. So this really brings us to the heart of the matter, right? The central conflict of the whole quarter. A beat on sales that somehow leads to a drop in the stock. So let's look at the numbers that created this whole paradox. And here it is, laid out in black and white. You can see the paradox right here. Revenue, a nice little beat. Awesome. And the official loss, what we call the GAAP number, was actually smaller than expected. That's good too, right? But, and this is a huge but, when you look at those adjusted numbers, the non-GAAP figures that, let's be honest, most investors really focus on, that's where you see the problem, a big, big problem. Both adjusted earnings and EBITDA were just significant misses. And that, my friends, is where this whole story really takes a turn. All right, let's break this down even further. Because when you really pull the numbers apart, you get this tale of two completely different quarters happening at the exact same time. On one hand, you've got this absolutely incredible growth. And on the other, a massive wall of challenges. And this slide, wow, this just perfectly captures the dilemma for investors. Look at the left side. The good. It's a dream. Record revenue, record bookings, a gigantic backlog of future orders, everything you could possibly want to see. But then you look at the right side, the bad, and it's like a sea of red ink. Gross margins got sliced nearly in half, and they even had to cut their earnings forecast for the rest of the year. Ouch. So let's focus on that good stuff for a second. A book-to-bill ratio of almost 3-to-1. What does that even mean? Well, it means for every single dollar of product they shipped out the door, they'd booked almost $3 in brand new orders. That is just an incredibly powerful signal of future demand and, real market leadership. But then we have to talk about the other hand. A miss on earnings of this size, this sent an absolute shockwave through the market. We're not talking about a rounding error here. This was a fundamental miss that made everyone ask the same questions, right? What's going on with costs? How efficient are they really? And most importantly, can they actually turn that beautiful, massive backlog into actual, real profit? So you've got these two conflicting stories. What did management have to say about this disconnect? And why did the market react so harshly? This is really where the narrative just splits into. You've got management's grand long-term vision versus the market's, let's call it, short-term panic. If you listened to the earnings call, the narrative from the CEO, Wahid Nawabi, was one of just total confidence. He kept hammering home the record bookings, the big strategic wins, saying, hey, look, this is proof our long-term plan is working perfectly. He basically framed all these profit problems as just, temporary, short-term bumps in the road. The market, though, it wasn't buying it. Wall Street was fixated on this one number, the collapse in gross margin. Look at that drop, from 39% all the way down to just 22%. This, right here, is the absolute core of the problem. It just means for every dollar they sell, they're making way, way less profit than they did before. So what was their excuse? Well, management basically pointed to a perfect storm of problems. They said the new BlueHalo acquisition brought in a lot of lower margin business. There were some big accounting charges from that deal that aren't cash but still hit the books. And then, on top of all that, they had these operational headaches, like a government shutdown messing up shipments and really costly software upgrade. Okay, so what's the plan to fix it? Well, their guidance lays out a path to recovery. It's clear, but man, is it difficult. They're promising this huge rebound, but here's the really crazy part, the catch. A staggering 70% of their profit for the entire second half of the year has to come in the final quarter alone. That is an enormous bet on having an absolutely perfect Q4. All right, so let's put this all together.
What do you, as an investor, need to be watching for in the next earnings call and beyond? I mean, where does the rubber really meet the road for this whole turnaround story?
These are the questions you gotta be asking. Can they start showing that margin improvement right away, like next quarter? How quickly can they start turning that massive $1.1 billion backlog into actual profitable revenue? Are we gonna see any signs that they're on track for that, frankly, heroic Q4 performance they promised? The answers to these questions, that's what will tell us if this was just a one-time blip or, the beginning of a whole new, less profitable era for the company. So, where do we land on this? Our official take here is market perform. Look, the growth story, the demand for their products, it's undeniable. It's absolutely best in class. But that execution risk, with everything piled into the last quarter and the huge uncertainty around their margins, it's just too big to ignore right now. We think the upside is pretty much capped until they can actually prove they can deliver on these promises. All right, so for our final segment, let's talk about a potential trade idea. How might you approach a situation like this? It's that classic mix of incredible long-term promise and a whole lot of short-term fear. Okay, so whenever a stock makes a huge move like this, fear in the market goes way up. We call that implied volatility. So one strategy to consider is selling cash-secured puts. Now what's that? It's basically where you get paid cash today, that's the premium, in exchange for agreeing to buy the stock at a lower price if it drops. It's a way to kind of take advantage of all that fear, generate some income, and maybe even get a chance to buy a stock you like at a discount. So, to wrap this all up, what a complex quarter, right? You've got this unbelievable growth story smashed right up against some really serious questions about profitability, and it's left investors with a tough choice. Do you bet on the powerful long-term demand, or do you worry about the very real near-term risk that they just can't execute? The big question here isn't, is the demand there? It's, will the profits ever follow? This is not financial advice.